Welcome. I'm Chris Blasi. Welcome to the November 2021 edition and episode of On the Move. I'm joined tonight by my usual colleague and co-host, Rich Checkan. And Rich will introduce our guest tonight, which you're going to really enjoy. But just as an overview, tonight we're going to be touching on some subjects that I know everyone is interested in. And the action in the last several weeks, and even today, so the timing was excellent, really is raising people's interest. And that's going to be, we're going to be talking about inflation, interest rates, the US dollar, and of course its effect on gold, silver, and the precious metals. But before I move any further, Rich, great to be with you again tonight.
Great to be with you, Chris, as well. And everybody, I'm sure knows my co-host, Chris Blasi. We've been doing this for years at this point. But Chris is the founder and the inspiration behind Neptune Global and the Precious Metals Composite, PMC ounce, fantastic product. And I think anybody that knows us knows that we don't sell anything we don't believe in. And the fact that we sell PMC ounces should tell you we believe in them. Chris has done an excellent job. He's got his background, obviously, in the financial markets and the IT markets. He's kind of worked for large and small brokerage firms. He's quoted by a who's who newspapers and on-air talking head shows. You know them all. Chris, love the knowledge and experience you bring to the table. And I don't know if you had much chance to work with Chuck in the past, but I will tell you, you're in for a treat tonight, as are all our listeners. Chuck Butler, just an inspiration for me, good friend. I've known him now. I've been with ASI for 25 years, and immediately I was introduced to Chuck. We used to deal in foreign currencies as well as precious metals. One of our suppliers was Mark Twain Bank, and that's how I initially ran into Chuck Butler. And Chuck basically ran their bond desk. He ran their currency positions for Mark Twain Bank. Back then, I believe, actually before then is probably when you started writing the Daily Pfennig, if I recall. Yeah. And then I know you hooked up with Frank Trotter and started a wonderful new online bank, Everbank, and we're there for many, many years. That got us a chance to see each other all the time at the different conferences and speaking engagements and so forth. But, you know, here at ASI, I say this all the time, and I don't say things I don't mean. The Daily Pfennig, or, you know, a Pfennig for your thoughts is how it started out, a penny for your thoughts, right? The old German Pfennig was a penny. A penny for your thoughts is required reading here at ASI. It is just a wonderful, quick snapshot delivered so well on the markets and what's going on in the world. And, you know, if you want to start your day with the one-touch source, it's Chuck Butler. And I'm pretty sure most of our readers already know that. But Chuck, welcome to the show. Really glad to have you here.
Oh, well, thank you, Rich and Chris. I really appreciate this opportunity to get to speak to people. You know, I since I've been retired, I don't get out to conferences and stuff anymore. So I don't get a chance to talk to people unless it's through one of these Zoom webinars. So I really appreciate this opportunity.
Well, Chuck, we're going to put you right on the hot seat. And I know you have some thoughts in this area because I read you daily. When I go to conferences right now, and actually for like the past year, there's one question I get at every conference all the time from pretty much everyone, okay? Given the backdrop of our economy with rising inflation and everything else, why are gold and silver not moving? And what is it going to take to finally get them moving? Of course, you could just say, well, they already did today, but I'll let you answer.
Well, there's a couple things involved in getting gold to move and really, you know, start taking its place as the inflation fighter. The first thing that I want to talk about is how the eastern part of the world, they think of gold as a store of wealth, which is what it should be, a store of wealth. In the western part of the world, here, like here in the US, we think of it as a commodity that can be bought and sold, or should be bought and sold when the price rises or when it drops. And so until you get people in this country to start looking at gold as a store of wealth, to buy it and put it away and not worry about the price going up or down, then gold's always going to have these bouts where it goes up maybe $20 in one day, and then the next day it's down $10 because profit taking sets in. That's the main thing that would change the direction of gold. The other thing is that we've had some manipulation, if you will, of the gold price and silver price for a number of years now. And if you look at the number of days that it takes to produce the amount of silver to equal the shares that are the contracts that are sold, the ounces that are sold in short contracts, it would take 148 days of production of silver to equal all those short contracts. That's just unfathomable to me. But the good thing is that it used to be 185 days. So it's come down some, but it's still a great number of days that it takes to offset all those short contracts and production of silver. So someone out there, and we basically know who they are, the bullion banks, they basically show up at COMEX with arms full of short contracts whenever gold starts to move in a direction that they don't want it to move. And I've always said that, and the only thing that I have to prove this point is some WikiLeaks memos that went out back in the 70s when they first removed gold from backing of the dollar. And that is senior senators and Kissinger were talking about how they needed to do something to keep people from going to gold instead of holding dollars. So that's why I always have thought that the government was behind it. That's why these bullion banks are allowed to do what they do, because the government just gives them the wink and the nod and says, go ahead. We can't have people getting into gold and not holding dollars. So
do you think they take, Chuck, do you think they take their that privilege, if you will, to do propitious trading, knowing that they have to be the other side of the transaction, et cetera? They know where, if all of a sudden there's some massive selling where it's going to trigger, stops along the way. Do you think they see those opportune moments and just take advantage of them to plunge it downward and then buy back cheap?
Oh yeah. I mean, anytime there's any kind of just small profit taking in gold or silver on a day, you'll see these short contracts just flood the market, and they will take advantage of it. And they'll say that, gold went down today because of X. Well, it went down today because you sold all those short contracts, but that's a different story.
Yeah, good point.
And we've also seen through the years the timing of the sales of those contracts. We're always at the least opportune time, right? Thinly traded times in the market where any true investor would never do that because it's be hurtful to his position. But when you're doing the work, and the only game in town that is threatened by the rising gold price is the U.S. government, the issuer and the Fed, the issuer of the dollar. At the end of the day, Wall Street, I don't think they're enamored by that. They just want to make money, manipulating the gold market. They can do the same thing in the stock market a lot easier, actually, because you don't have any physical component behind it. But I believe kind of shows that they're doing the bidding for the government.
Gotcha. I think part of it as well, I mean, I've said this for several months now. I've spoken at different conferences. I think part of it too is just the Fed's created this amazing everything bubble where virtually everything goes up in value. And, let's face it, greed rules the day. If people can just throw money at the wall and it turns into more money, why wouldn't they continue to throw money at the wall? And I think that's what we're seeing. And, people ask me, well, when is gold going to take off? My thought is when people start getting more fearful than they are greedy. And that just hasn't happened yet. Because let's face it, when you can, spend millions of dollars on an NFT that represents art that is basically nothing, a blank canvas, there's too much money sloshing around, and the Fed created that. So that's got to kind of work its way through. Money's got to slosh around. People got to lose money before they start getting scared, and then they're going to run to gold. I think that's going to happen, and maybe some of the inflation numbers we saw today started a little bit of a panic, and maybe that's what we saw today as well.
And let me just ask both of you, and I'm sorry, even to Chuck's point about in the West, they don't appreciate gold for its as a store of wealth. And everyone is impatient, right? So no one wants to hold on to insurance. It's literally financial insurance, right?
Yeah.
They want something that is going to, at least they could believe, is going to rocket up higher, and that's why I think a lot of these NFTs and the cryptos have enamored folks. And also, because it appears that the stock market and the bond market is supported by the actions of the Fed, right? Those have been they've appeared to be no-lose casinos, right? So everyone's complacent and they actually feel, well, this time, I think this is a version of this time it's different, meaning this time it's different. We never need to secure and have a store of wealth and gold. But, every time that position has been embraced, it's always been proven to be wrong. Sometimes it takes a little bit longer.
It's never different. For 5,000 years, it has never been different. What are your thoughts, Chuck?
No, I agree completely that the stock market right now is just beyond belief as to the price to earnings and everything else that's going on. And then you've got the Fed that's always coming in and doing either quantitative easing or buying bonds and putting more money into the system, that people, and keeping interest rates very low, even in the face of rising inflation. Today there was Mary Daly, the San Francisco Fed president, said that they're not ready to start raising interest rates. It's too soon, and with inflation running at 6.2%, I just don't get it. But anyway, they're manipulating the markets. The Fed is keeping interest rates low, so there is no reason for people not to be buying stocks at this point, except that the bubble, in my opinion, just keeps getting more air blown into it. It's floating around a room looking for a pin right now. And when that pin pops that balloon, you will see people moving back into gold quickly.
Gotcha. One of the questions, Bill just chimed in here. He said, are cryptocurrencies being perceived as the new inflation hedge, keeping the lid on gold and silver prices? What do you guys think?
I'll let Chuck answer first. There.
Okay.
Well, in some people's minds, maybe the cryptos are an inflation hedge, but I just don't see the future of the cryptos, except from a government standpoint. And so I just
is not a good one.
Yeah. No, and I wrote a really long article about this one time about the digital currencies here in the U.S. and how that would be a major blow to people's civil liberties, their rights, their information, their personal information, because everything's going to be known to the banks and the governments as to what you're doing if it's digital currencies, and folding currency is outlawed. So anyway, getting back to what we were talking about, I just don't see it as an inflation hedge. I really don't. But I think that people are thinking that, and you are what you are perceived to be. So
Yeah, I couldn't agree more. I've been quoted as saying that central bank digital currencies were concocted in hell by Satan himself. Okay, I absolutely believe that it's the end of personal freedoms. It's the end of it's the total control of governments over your finances. It's not a good thing. And central bank digital currencies are the opposite of crypto decentralized currencies. I don't think they're inflation hedges because they're not acting like them. They're acting like a speculation. And as long as they're a speculation, that's what they are. Allocate 1% to 2%, no more of your portfolio to it. And if you hit it big, take the profits and bank it into something you can trust, like gold.
Well, there's so many aspects to the cryptocurrencies that you could look into. And
Be right back.
on a very high level, there seems to be a lot of not real understanding what they are. And I'm even going to go as far as even the technology behind it and the limitations. Also, I believe the thought that the government could not stop transacting or allowing people to transact in cryptocurrencies by just outright outlawing it. I mean, one of the things you see is to end it, to give it legitimacy, is that they keep parading out companies who will now accept Bitcoin in exchange for their goods or services. Well, if the government just turns around and says, we have our own digital currency, we're not going to compete with a private one, it is now illegal to accept, you name it, Bitcoin, Ethereum, well, all those companies will stop it tomorrow. I mean, just the way they follow every directive that is demanded of them by the government, they will stop it. And all of a sudden that pillar of support will completely disappear. So, and then you say, okay, people will argue that, well, then it'll be, between individuals privately. Again, the government could shut it down tomorrow. So I think that's a risk factor that in all the euphoria, when people keep talking about how much they made in Bitcoin, and it's really been trading sideways for some time now, even with all the hype, it's really not exploding. But I just think people need to really evaluate the risk, and it has a very short track record. And in all reality, they're really one of the only assets out there that can truly go to zero. And no one can say, unless it's just their gut feeling, but that a crypto cannot go to zero tomorrow. Gold and silver will not go to zero. It's proven it for 5,000 years. It's not going to happen. It may not go up as fast, or it may not go up at a price that a lot of people feel it should be, but it's not going to zero. And hopefully people get a greater appreciation for that going forward.
Good point. All right.
Let's jump to the next thing that is kind of, because we're talking about the dollar, and that's the reserve currencies, the reserve currency status of the U.S. dollar. So, how many commentators have speculated that at some point the U.S. dollar may lose its reserve currency status, but the argument is always, but what's out there, what the alternatives are horrendous, and that's correct. And I think that's why it continues to be the reserve currency status. It does lose a little bit. If you look at its market share, it is slowly ticking down, but nothing dramatic. And of course, for our listeners, the reserve currency status of the dollar does not have to be lost for gold to really go up a lot in price. I mean, in all reality, gold entered the new millennium at $270 an ounce. We are at 1,800, right? And the dollar is still the reserve currency status. So, but with that said, Chuck, what is your thoughts on the dollar's, the reserve currency status going forward?
Well, basically, the euro was created in 1999 to compete with the dollar for the reserve currency status. And they were moving along pretty well for a long time until the debts of Greece and Spain and Portugal and the rest of them were exposed, and Germany had to basically bail everybody out. And so since that time, the euro has not been able to get off the canvas and move forward and become that competition to the reserve currency status. It is the offset currency to the dollar, though. So basically, when the dollar goes down, the euro goes up, and there doesn't have to be a reason in Europe for the euro to go up. It's just that the dollar goes down, the euro goes up. It's the offset currency to the dollar. The Chinese renminbi was also thought to be a candidate for a reserve currency, but they still don't have full liquidity of their currency. Dealers around the world do not trade in renminbi, and until that happens, China's not going to be the reserve currency. So, Chris, I think you're right. At this point, there are no alternatives to the dollar being taken away as the reserve currency. But the thing to think about is that if it did happen, or when it does happen, it won't be a good thing for us in the U.S. I mean, I used to tell people all the time when I gave presentations that you remember back in 1964 when the Beatles came to the U.S. and were on the Ed Sullivan Show, and they showed us pictures from Liverpool at the time, because that's where the Beatles were from. And all these pictures were so depressing. Factories shut down and everything else. I mean, it was very depressing. I mean, they were in black and white, so that added to some of the depression, but I mean, they were very depressing. The point is that the UK had lost the reserve currency status after World War II. So, the mid 40s all the way to the mid 60s, 20 years, and they still had not recovered from not being the reserve currency of the world. And that's the kind of stuff that we would see here in the U.S. with increased costs of commodities, increases in interest rates. We wouldn't be able to run up debts as easy as we do. So those are the things to think about if it ever actually comes to that. But right now, I just don't see anything out there that's going to replace it.
I have a feeling they'll be introducing the central bank digital currency before the US dollar loses the reserve currency status. How about yourself, Rich? Any thoughts on this?
Yeah, again, I think that there's no viable candidate, so no time soon, although you see all these countries trying to look for ways to work around the dollar. Let's face it, we've mismanaged and we've abused our reserve currency status. And as a result, it is no longer as attractive as it used to be. And I think people are going to look for ways to get around it, plain and simple. And when that happens, and it may eventually happen, when other currencies reign supreme in past, and those countries are still around, their standard of living just isn't what it was. And in this particular case, where the world is financing our lifestyle, when that goes away, I think Americans are open for a huge wake-up call.
Well, and just to add to that, we've seen Russia de-dollarize.
Yep.
They sold all their treasuries, and they're making sure their businesses in Russia are not dealing in dollars. And China is also on a de-dollaration program. Yes. Although they've still got tons and tons of dollars in their reserves. So we are seeing countries that are trying to do something about their exposure to the dollar, but none are ready to take over the reserve status.
But a lot of central banks are buying gold, and that's ramped up.
And I have to say this because I'm going to tie this back into the cryptos too. And when we talk about, are people seeing cryptocurrency as a new inflation hedge, or we've all heard the term, is it the new gold? At the end of the day, the power players are still the governments of the world, right? And the central banks. They are not buying cryptocurrency. Granted, you get hedge fund managers. That doesn't count. Those guys are in and out of markets. They just go into markets to make a profit. I mean, people shouldn't conflate that that's a stamp of that there's something they're not, all because a $1 billion hedge fund manager says, I'm going to buy Bitcoin, because he'll take his profits and he'll be done with it. And if crypto stops performing, they're through. That's different than central banks buying gold as a store of wealth, as a reserve asset. So I think we should never lose sight of that, or investors should never lose sight about that. The people who are with the real power in the room, they're buying and holding gold. They're not going into cryptocurrency.
Yes.
100% agree. So I think there you have it. We're all kind of a consensus, reserve currency, yes, will be for a while, and no viable candidates, but watch out. If that happens, it's going to change things drastically for Americans. I'm going to move on. Over the past week, we heard that we're going to do some tapering, right? My favorite quote going back, and I know Chris has heard this before, I don't know if Chuck's heard it, but Jerome Powell, basically, he said, we're going to begin to talking about tapering. And then somebody threw that in his face at one of the FOMC meetings. He goes, yeah, I think we're going to have to retire that phrase. It has served its purpose. And that just drove me nuts, because basically all it means is their job is to confuse and placate us, so we don't ask the real questions. But anyway, they were finally there. They're going to taper, and they're going to knock down $15 billion in asset purchases every month. And the markets are reacting a bit. But what does that really mean? I mean, people are looking to bonds, right? And 10-year treasuries to try to get an idea of where things are going. Does it even tell us anything when the government owns the majority of those treasuries? I mean, Chuck, this is where you cut your teeth in the financial markets. And I don't know that it says anything when the government controls and will for decades the bond market.
Yeah, that tapering thing is just a little bit too much for me. I mean, they're going to drop 15 billion from the 120 billion of treasuries and mortgage-backed securities that they were buying every month, 120 billion. So now it's down to 105 billion, and you think, what is that? A drop in the bucket, It's like when I used to try to lose weight, and people would say, yeah, it's like removing a bucket of sand from the beach, it has that much effect. So I would think that basically what the Fed is doing is lowering the amount of bonds that they're buying every month. And they'll do it all the way until we get next year sometime, when inflation is just really going higher, and they're going to have to do something because they can't raise interest rates. The debt in this country is too large for them to raise interest rates and increase the cost of bond servicing. So what are they going to do? Well, they'll go right back into a huge bond purchase program to appease the markets, because otherwise the markets are going to be screaming bloody murder for an interest rate hike. And I don't mean just 25 basis points or 50 basis points. I mean, if we got back to normal interest rates, like maybe 5%, the amount of cost to service the bond debt in this country, the debt in this country, would overtake all the other tax receipts that we take in, and there would be no money left over for any of the welfare programs or any of the other things that the government does. So they're playing with fire here, and you know what they say, when you play with fire, you get burnt, and I think that's what's going to happen.
That's Chris.
Well, I mean, I'll boil it down to, they always said if everything was allowed to not be supported, we'd have massive deflation. But they can always print enough money to overcome deflation. Some people claim they can't. I believe they can because it's happened throughout history. And the system will come to an end, and it will be through massive money printing. They're not going to let it collapse through deflation and lack of support, regardless of what it means for the cost of living for everyone here, because the flip side is just as destructive. So I think history proves our government is behaving no different than any of the ones that we all point to who had fiat currencies, who came, and their systems came down. So to think it's going to play out any differently, I think, is not realistic. So they will continue to print. They'll do some little announcements like they said today, which means nothing, 15 billion on 120, but soon as there's any pain in the market, that's going to come right back. So, and I think that's what they're going to continue to do. And they'll continue to try to massage the numbers so that the real rate of inflation that people are experiencing in their day-to-day life They're going to claim it's not what it is. No, it's far higher. So even when they came out and said it was 6+%, I think for most people, the experience is worse than that. But
I think
also,
it's really like 13% or something is what Shadow Stats tells us, right? If
I
you
would
go back
think so.
to the way they used to measure it. So,
And another thing, so many measuring sticks don't mean anything anymore. And that's why I'd like to try to project what's going to happen. And this is just my opinion, right? But when people will use metrics, let's just look at the stock market. There is no, fundamentals don't mean anything anymore. PE ratios. So we are where everything is turned upside down in the world we live in right now. So it's futile to even look at anything. I mean, I remember 10 years ago, remember when they talked about if the debt gets to this level, the whole system will come crashing down. It never happened. It just keeps going on. It keeps getting more distorted. But that means, I think we're the point, and this isn't saying it because we're advocates of precious metals, but it's almost like, don't waste your time. This is what, in my opinion, this is what they're going to continue to do. And you better have a store of wealth that can actually survive through the meat grinder that's coming. And the metals are unique unto themselves. Bonds will be major casualties, and so will stocks, and so will real estate. So make sure at least you have something, so when it comes out the other end, you have dry powder, and then you can capitalize on the mess that's out there.
there is a question kind of related. It says, how do we prevent the next major drop in the market since 08-09? I don't know that we're going to prevent it. What do you guys think? The Fed has created the bubble. Eventually balloons find pins and they pop. What they've done though is when something is popped, they've inflated a new bubble. So, I mean, is there a way to prevent the stock market and other things from collapsing?
Well, I mean, the only thing that they can do is keep interest rates low and keep printing money to keep the markets happy, and that's the only thing they can do to keep the stock market afloat. But I just don't see that as we go along. Sooner or later, you're going to get the markets are going to become very numb of these numbers, and they're going to revert back to what they know, and that is that money printing equals inflation. Inflation is a tax on individuals, whether it's whether it's a stated tax or not. It is a tax because it reduces your amount of disposable income that you can spend. And then they'll start looking at PE ratios for stocks and stuff again. I wrote this morning in my letter that one side of my brain said that the Fed's tapering announcement was an attempt on their part to get back to fundamentals, but the other side of my brain said, no, there's no way that that's going to happen. So,
well, inflation, I've written about this as well. So there's two taxes, right? So you have the overt taxes that, if you earn this, you're going to pay so much and give it to Uncle Sam. If you buy this, you're going to give it to Uncle Sam. If you're going to do this, you're going to do that, you're going to give it to Uncle Sam. Those are clear, stated, overt taxes. The insidious covert tax is inflation, and that's a tax on every consumer, like you said. And that's fine, and we can live with that as long as wages keep up with that. But they really haven't, have they? I mean, you go back, I think our wages are probably on par with what they were 30, 40 years ago. Am I mistaken, or is that pretty accurate?
No, that's pretty much.
Yeah.
So,
that's part of the problem is, we should be feeling this. And if we're not feeling this, I think we got our heads in the sand. You don't buy groceries, you don't buy fuel, you don't buy anything if you don't see the effects of this inflation, and it ain't 6%. So.
And I would just like to add to the question, which was, how do we prevent the crash that we experienced in 2008-9? I'd actually say the reality is we have been preventing it. They have been doing it through money printing, right? It's just, when does that preventative measure fail? It doesn't work anymore.
Yeah.
Because if it wasn't for the trillions that have been injected into the system, the stock market would not be where it's at. Real estate would not be, real estate prices would not be appreciating the way they are. and yields on bonds would be far higher. So no, they have been preventing it.
Gotcha. Unless there's any thoughts on that, there's another question out here. I love the questions. I think this is the most important part of the webinar, to be honest with you, because we can talk about whatever the hell we think you want to hear. But until you tell us what you want to hear, there's nothing more important. So the question is, how solvent really is the Social Security system? And this gets in, or the Social Security program, and this gets into a whole can of worms, ball of wax that I think is critical and not enough people are talking about. Who wants to jump off on this one?
Well, when I was a young man, not on Social Security, my dad told me not to depend on Social Security when I got older because it probably would.
Smart dad.
And so now I'm here and it is around still. And I thought, well, it's bound to go broke sometime. The problem is that
Well, Ponzi schemes do, right?
Yeah. But what difference does it make if it does run out of money? They'll just print more money and fill the coffers. So I don't see that there's any risk of it collapsing or going away. Now, I do see the benefits being reduced over a period of time because the government's going to need some of that money. But
raid the coffers, yeah.
Yeah.
What about you, Chris?
Well, yeah, as long as the dollar exists, there's no reason Social Security will stop functioning. The purchasing power of the dollars you get in it may be far lower than they are now. But as long as the US dollar exists in the world, they can, to Chuck's point, they're just going to print it and that's what they're going to hand you. I think, you have to look at it and just say, well, what was it like to be a pensioner, maybe in a country whose currency, like in Argentina, right? Yeah, their currency stayed, but it was always devaluing aggressively. And always, those people always suffered from a lack of, diminishing purchasing power. So, none of us on this call, probably not a single guest, because since post-World War II, we've been in such a powerful position. We've never experienced some of the hardships of living in countries whose currencies became also rands, but that may come. But Social Security will soldier on.
Yeah, I don't think Social Security was ever supposed to be the full answer. It was supposed to augment. Of course, back then we had pensions from companies where you stuck around long enough to actually retire from a company, et cetera. But a lot of these companies and the public sector as well have based their calculations for their pensions on numbers that don't make any sense at all. I mean, what are those, like 7-8% return is what they're looking for? How are you going to get that in this environment with artificially low interest rates? And, it's just not fathomable to attain the conservative assets and performance that they're looking for to meet the goals to pay out what they've promised. I don't care if it's pension plans. I don't care if it's Social Security. I don't care what it is for the future that you're depending on. I don't think it's going to be enough. You need a little bit of everything. And by God, you need gold, you need silver to store that wealth, to store that purchasing power. If that's not a component of your retirement assets, you have missed the memo. I'm telling you. Any disagreement there?
No. I mean, I agree. I mean, I've been writing about these pensions in the U.S. for a number of years now. And after 2008, I was down in Florida for spring training with my spring training friends. And the one guy said, well, Chuck, now that that's, been taken care of or, over with, what's the next big thing, that's going to hurt us? And I said, pensions, because they're so underfunded. And you had, at that time, you had 10,000 baby boomers retiring every day for the next like 20 years. And so all these people were going to start really putting a number of problems on these pensions that are so underfunded. And this is a problem that's out there that nobody's talking about.
And now, so the onus of paying into that is coming from people that we're paying to stay home and not work right now. So we just destroyed the equation even further, if you ask me. Chris, you have a comment there as well? It looks like you were ready to say something.
Nope, I'm in agreement.
All right. So there's another question here. It says, you mentioned the debt, and this might be for you, Chuck, because honestly, some of these gyrations that the government does in terms of owning their own debt just makes my mind explode. But the question comes from Burton. It says, you mentioned that the debt would become onerous if interest rates rose. However, doesn't the U.S. Treasury receive the coupon payment from the U.S. Treasury bills and bonds, which is then available for government uses?
Well,
I think Peter's
yes,
going to get pissed off about being robbed by politics. I don't know, but go
yeah,
ahead.
no, that's true. I mean, they do. The Fed does pay the Treasury on the interest rate, but it still is a big weight on the government to have to service the debt that's out there that's not owned by the Treasury, okay, or the Fed.
Yeah.
I mean, there's still a lot of bonds out there that in the world that have to be serviced, and those would still become a great onus on the Treasury.
And it doesn't take too big of a rise in interest rates to make it onerous, right?
Right, exactly. So like
Just because of the sheer
if
size.
if it went up to 2.5% interest, the amount of billions that it would take to increase the debt servicing would be huge. And then if we just even went to a nominal 5% like we used to be, in 1999 we started Everbank, and our interest on our checking accounts were 6%. Can you imagine if interest rates were 6% now? It would be bad. It would be bad.
Sounds like an REM song.
Yes.
It's the end of the world as we know it. So Deborah's got a couple questions here. One was specific. I don't know if anybody can share. I'm not a tax guy, but it says, how do I prevent from selling real estate and not be taxed like a rich person, as a person who is used to making $400,000 without doing a 1031 exchange? But she also asked for any general tax tips for the middle class. I don't know if
Let me just, on behalf of all of us, we are not tax advisors, and we could share. Here's what I'll just speak to. I see the legislation that is pending and what it's going to mean for taxes for small business owners, and some of the things they're looking to do in the world with real estate, even like what they call self-directed IRAs, and preventing, people, small real estate investors from using their 401k money. And I would just say this isn't a tax tip, but the so-called any advantages that used to exist, the government, when they always look inept, one thing they're good at is closing and levying more taxes on you. And what they're doing, and they always couch it, oh, don't worry, most people, because it's only for the folks making 400,000 or more, which is actually, that's not Bezos money, right? But the reality is, we are taking away everything that was of any benefit to small business owners, small to mid-sized landlords. And when I say small landlord, I'm talking someone even with $100 million worth of property. I mean, when they talk big, they mean BlackRock, right? Or Blackstone. Those are the guys they're talking about, not the guy that owns the $25 million apartment building. He's not a big time player. To most people, that seems big, but it's not. So unfortunately, I mean, we're business owners, everyone on the phone, on this call, and everything you see they're doing, to me, it's a very orchestrated, concerted effort to eviscerate the middle class, right? And the upper middle class. And that's what I see is going on in this country. It is just continuing to stratify between a small 1 to 5% and everyone else. And every action I see them doing is detrimental to the to that group just under the 5 and 10% of the upper. So it's not a tax tip, it's just a reality. And then net, meaning there's less and less plays to lessen your tax burden. They are eviscerating all of them, expunging them.
Sounds painful.
And the point I'd like to add on to that is that right now they talk about just, taxing these people at these high earners and stuff like that. But what happens in a couple of years when they find out that all those receipts from those high earners don't actually meet what they thought they were going to meet? Then they're going to lower the amount of money that it takes for them to get your taxes up, and keep lowering it until it gets down to everybody. And that's basically how the government normally works.
Gotcha.
Absolutely.
All right. I want to throw one question out to everyone, and then because I don't see any more trickling in here, and then maybe kind of wrap up a little bit. But I think a huge portion of our listenership, readership, customer base are very close to, if not in, their consumption years at this point. Now, some of them may not have gotten a chance to exercise that state in life because of 2008, 2009. I personally believe there's a lot of folks that expected to retire 2009, 2010 that are still working to this day to make up the 40, 50% haircut that they took in 08, 09. And I think there's a problem with the pension system, with Social Security system, et cetera. I think, the loss of purchasing power is a real issue. It's the number one killer, in my opinion, inflation of, retirement income. What, if you had to give one tip, or actually, let's do it this way. What do you think is the biggest risk to retirement income? And what do you think is the best way to protect it? Maybe we can go around and just have everybody's thoughts there, because I think that will be very useful to our readership.
Well, I think the biggest risk to retirement is, well, there's two of them. One, having debt, and two, healthcare costs. Healthcare costs are very high, and they can eat away somebody's disposable income that they have on a monthly basis if they're retired. The other thing is, to be in debt is, I've always said debt is the same as slavery, because you're going to owe somebody something for the rest of your life, probably, if you have that much debt and you're at that age. So it's just not a good thing to have if you're retired.
Gotcha. Chris?
Okay, so now I see the biggest risk is, we know because of the lack of income producing assets that people have been pushed and taken on more risk through the years, with a lot more exposure to the stock market, which 20 years ago, where folks were buying CDs yielding 6 and 7%, right? 25 years ago. And then they can feel secure because that wasn't going to be, they don't have to wake up each day worry that maybe the market, turned on them. That you see everyone on quote unquote one side of the boat. They've all, there's so much equity exposure. And right now that market is being supported. And if that support either ends, whether by choice or it's just forced upon them, and then that market takes a rapid hit, and so many of these, the baby boomers are really, what average age is probably the low 70s right now, right? They'll never be able to make it up, right? And then what does that mean? So we've created, not us, but the powers that be and the policymakers have created this extremely precarious place that we're at. And that's a risk that I don't think it can be sidestepped, right? I mean, I'm not going to say it again, because people on the call know that we feel that there's a position that you should have in a certain time-tested asset that would or should do well. But, obviously you can't put everything into it. So sometimes you get yourself into such a position it's risk, and there's not going to be any easy way if the market moves against you. And that's where, unfortunately, I feel we're at, that there isn't going to be an easy pat way to if things start to move in the opposite direction, that you can immediately just go to something else and you'll be whole, and it's not going to impact your retirement income or the money you need to live. So it's not an answer, because I don't really think there is an easy answer.
Yeah, and the point that you made is very important, that what a lot of investment advisors tell their people is that, you know, you don't worry about the stock market falling because it always has come back. Well, when you're in your mid 70s and it takes 20 years for it to come back, it's not going to do you any good.
Not much consolation.
Yeah, so that's the thing you need to always question them about.
Sure, and don't forget the folks that move from income producing assets because the rates are so low, who went into equities, what they'll sell some of those equities off, right? They get gains and they sell some off to raise money, right? Well, even if it's not a 20-year comeback, if it's a 3 to 5 year, well, if your portfolio takes a 30% plus haircut like it did 2008 and 9, and you still have to live day to day, I mean, you're going to be selling. You're going to have to sell stuff off, you know, at much lower prices, and even though if it starts rising 3-4 years from now, there's going to be a lot less assets in there to rise. I mean, it's not going to be an easy transition, and it won't be a painless transition, right? I guess with the few tools that are out there, and that's what I think there are. This is one thing that I think a lot of folks aren't used to, because sometimes they don't want to hear not the gold and silver answer again, but there really aren't a lot of tools as alternatives to an overinflated stock market and bond market. And just lastly, and real estate, there's the problem with real estate is lack of liquidity and divisibility, right?
No, I think gold serves the same purpose as real estate. You know, they're not making any more dirt. They're not making any more gold. It's just gold is a hell of a lot more liquid. Okay, that's really, for me, the biggest difference. You know, when I look at wealth insurance, we define it as the store of purchasing power in a very liquid form for potential financial crisis you hope you never have. I personally think the biggest threat to retirement income or fixed income portfolios in general is inflation. It's a loss of purchasing power. It's less buying power of whatever you have amassed in your lifetime during your accumulation years. And best protection against that is to stay, diversified. A big part of that is having your wealth protection in your portfolio. You own 10, 15%, whatever it is, and you hope to God that 90 or 85% of your portfolio does better. But if it doesn't, you're prepared, you know. So that's the way I look at gold, and you got to have it in your portfolio now more than ever. If I could just maybe go around, get a parting shot. We'll start with you, Chris, and maybe go to Chuck, and please tell folks how to get a hold of you and
sure, and I just want
do business with you.
I just want to say one more thing about the real estate, because it's just so big, you know, and Rich knows this because we're in a similar field. You know, the self-directed IRA world is predominantly real estate money.
Yeah.
Right? And, you know, we always say that, look, you know, they'll say, well, gold and silver doesn't give a yield and the real estate does. And that's great. It's true. But you know what? There's risks that if you said this was a risk 5 years ago, people would say you're out of your mind. And that what I'm talking about is the risk, these unforeseen risks, is the lack of rule of law. And I'm going to use this for real estate. When it came out that people were told they didn't have to pay their landlord, and basically all those small landlords were, in all intents and purposes, told to go pound salt. This is your loss. This is, you know, because you're gonna shoulder the loss because of the pandemic. You know, I know that supposedly they put some money aside for these landlords, but most of it never got out to them anyway, right? So the point is, you cannot even foresee and fathom, based on the life we lived before and how, you know, the laws were upheld, what crazy edicts will come down that would be hurtful. And there's where you see, you know, gold is portable, gold's divisible, gold's liquid. Things like real estate, yeah, billions, people became multimillionaires off real estate. I'll never take that away, but there's levels of risk, especially in the world we're living in right now, when you have a big stationary illiquid asset that could be in a jurisdiction like New York City, which is now a terrible place to be holding real estate. And these are risk factors I think a lot of people, dismissed or ignored or took for granted as not really being risked. So all I say is, again, the metals are proved to be completely unique in what their value proposition is for investors. But that said, I'll just say, guys, it was great talking with you, and I really want to thank everyone who came on. Neptune Global has some interesting products. We're a precious metals dealer, like my good friend Rich. We actually have a product that is designed to provide a better risk-adjusted return. It's a blended position in gold, silver, platinum, palladium, and it has done it since it's been in the market over the last going on 12 years now. And that product is available also. Asset Strategies International is an approved dealer in that product. It's called the PMC ounce, the precious metals composite. And I'd really encourage anyone just to go to neptuneglobal.com just to learn a little bit about us, and you can pull down a data sheet on the PMC ounce. And, I think you'd find it intriguing because it's not just a clever product. It's a product that was designed to provide whatever portfolio is supposed to strive for, and that's a better risk-adjusted return. So with that said, again, thanks everyone for coming on tonight.
Yeah. I love the product, Instant Diversity. Chuck, how do people get a hold of you?
Oh, well, before we get there, I want to say that one thing I've always told people is that, you buy fire insurance for your house in hopes that you never have a fire, right?
Good point.
You buy car insurance in hopes that you never have a car accident. You buy health insurance in hopes that you never have to go in the hospital. Why not have the insurance of gold for your portfolio? And then people will sit there and look at you like, well, I guess you're right. I don't know. So anyway, it's very easy to sign up for the Daily Pfennig. You just go to Daily Pfennig, and that's spelled PFENNIG.com. And there'll be a place, there'll be today's letter, archived all the old letters past letters that I've written, and there'll be a box over on the right hand side for you to subscribe. So you just put in your email address, and then you'll start getting it. It's free. I don't know how much longer I can keep it free. No, I'm just
hopefully
kidding.
forever.
It will be free forever. Yes.
But I will tell you this. We're closed tomorrow. And I just want to take an opportunity right now to say thank you from the bottom of my heart to all the veterans out there. We absolutely, and not just the veterans, but your families, because I can tell you as a veteran that your families have made incredible sacrifices as well, while you're out there sacrificing your life for us. And the ability to debate whatever we debate on a quarterly basis here on the Move, and whatever anybody else wants to agree or disagree about in this world. You're protecting our ability to do that, and we thank you from the bottom of our heart. So we will be closed tomorrow. Normally, we'll have a follow-up email out to everybody that registered for the webinar the next day. That won't happen till Friday. But when it comes out Friday, there'll be a link in there so you can go ahead and reach out to buy PMC ounce. There'll be a link in there so you can subscribe to the Daily Pfennig, and I encourage everyone to do it. Chuck's newsletter is free, like our Information Line newsletter, and we always tell folks that it's 100% free, and most people believe it's worth every penny or every Pfennig, right, Chuck?
Yes.
Now that I've closed everything up and asked everybody to give their parting shots, I've just uncovered kind of a treasure trove of a few more questions. So my question is, can you guys hang with us a little bit longer? Because at the top of the list, I see a really good friend, and Dennis Miller asked, will we ever see free market interest rates again? Does anybody want to comment on that?
I don't believe we will. I just really don't think we will. I think the government has figured out, and the Fed or the cabal or the cartel, whatever we want to call them, they figured out that they can control interest rates in this country. And it makes no difference whether it's deflation or inflation or what's going on. They're going to have the interest rates that they want to have, and that they think is correct for us. Like they know more, they know better than us. But anyway.
Well, that'll keep them from collapsing our economy too, right?
Yes.
Because they can't service it. So yeah, I tend to agree. What are your thoughts, Chris?
I agree. And the only direction they're going is to find more ways to control the economy. It's never going to be relinquished control. And I'll throw in one thing. I remember reading 10 years ago, you know how there's a delay in the Fed minutes coming out by a number of years?
Mm-hmm.
And I think this was about 12 years ago. Someone pointed out, way before digital currencies was even fathomed by most people, the Fed was talking about wanting to put a time value on money to force consumption.
Yes.
Right. And
I think that's what CBDCs are all about, by the way.
That's right. And that's the only doable with a digital, where everything is controlled by the Fed, by the issuing of it. And, basically you spend it or you
use it or lose it.
And so the point is, going back to free market. No, I agree with both of you. It's never happening. It's actually just going to get more and more centralized controls.
Yeah, I don't think cryptos are big enough for the government to worry about at this point. They're kind of a gnat on the windshield. If it become an issue, they would swat it like a gnat, swat it like a bug. I think their design is a bigger picture. It's control, and it is central bank digital currency, CBDCs. They can put money in, take money out. If you're not spending it fast enough, they can take it away. There's all sorts of things they can do. They can control your buying habits, etc. I think if that comes about, I think decentralized cryptocurrencies become the black market for currency. And I think your number one new form of cash will be gold and silver at that time. So I'm a firm believer that if traditional markets fail, black markets will jump up and fill the void in a heartbeat and do it very well. So. All right, moving on. I know we talked already about the reserve currencies, but somebody asked, well, if there was one, and we already said there's really no candidate out there. He said, what would be the answer? Is it a basket, special drawing rights, including commodities and currencies?
Could special drawing rights could become the reserve currency, but right now they're just designated for central bank usage. They would have to get a wider distribution of special drawing rights for that to happen.
Okay. There's a question, I don't know if it matters, but depending on geography and national affiliation, but do you have some advice specifically for Canadians, or do you think everything we talked about applies to Canadians as well? I think gold is universal and I think money is universal. But I think a lot of these comments, translate, but what are your thoughts?
Well, I used to always go in every year and speak in Vancouver. Okay. Yeah. And I always found myself talking about the dollar, and a lot of people there had traveled there from the U.S., but a lot of people there were from Canada, and so they would be so confused as to which dollar I was talking about, and but I would always assure them at the end that basically what I see, what's good for the U.S. is also the same for Canada. They've got debt up there just as bad as we do, and
that's a contagion that's running around the world. It's not just here in North America either.
Right.
So somebody asked, besides gold, where's the next best investment opportunity? Anybody care to comment on that, or do you have any thoughts?
Silver. No.
All right. I'm kind of along with you.
I know. What do you think, Chuck?
Other than
real
gold,
things.
I would say silver.
I think real things. It could be base metals as well, and I think somebody else was talking about that as well. Do we see a super cycle here for commodities? And I do think one's brewing.
I would agree. Yeah, the real assets are where it's going to be the store of wealth. It's just that all right, how do you own a lot of them, right? You don't have the convenience of actually owning the asset directly with really anything else except the precious metals. I mean, either you have to buy a company, who is a mine, which is still an operating business, and has all the issues that go along with that. So, but I would agree that the commodities or commodity companies directly linked to commodities would be it.
Gotcha. And then Linda's got a question here. She says, listen, if you hold gold, it's for insurance. What if there's a collapse? How do you use gold to buy bread and whatnot in the streets?
Well, I wrote about this the other day. The Venezuelans, you know how bad their currency has become. They
Shaving off
they just
piece of
keep adding
gold.
more zeros to it. They've been shaving off their gold to go down to the store to buy groceries. So they shave off pieces of it. I just knew that there would be a way that the people would find a way to use gold as money. And the Venezuelans did.
We've seen, go ahead, Chris.
And I just have to say, but even more traditional, as the dollar will still be here, just the way the Venezuelan currency is still there, just doesn't have a lot of purchasing power. And this is good about why the divisibility of the metals, like especially like a silver, right? So you can have 1,000 ounces of silver. I mean, if you peel off an ounce at a time, there's always going to be a market for it, right? I mean, every dealer, the biggest problem is if there's a collapse, there'll be a lack of supply, right? I think Rich will agree that, when there's a when the big demand comes for gold and silver, the biggest problem will be availability. So, we'll always be in the market to say, okay, we'll buy it back for cash because we're going to have buyers lined up for it. So I see it as you're not so much going to be, you look at our economy, and this is my opinion, you're not going to go in a big supermarket chain and really use gold and silver. Their point of sale systems won't support that. But you're just going to convert that gold and silver at the last minute, when you need the paper to go in and pay with this, low purchasing power, large quantities of whatever your currency is.
Agreed.
Not
Right. And the idea is that you would get more currency because your metal would
Absolutely.
and you just hold it
because the dollars are worth less, and therefore an ounce of gold commands more of them.
So if once a week you sell an ounce or two of silver to get whatever, $500, and then that's what you're going to use at the gas station. That's when you're going to use it, public supermarket or whatever. Because again, those systems aren't going to change. The amount of people that own gold and silver are so small. It's never going to happen where they're going to have one line for the guy with the gold and everyone else with the, for the US dollar. It's, you hold on to the gold to the last minute because in such a world like that, it'll constantly be, appreciating versus the currency. And then you convert it to the currency when you need to settle your, to buy things.
All right. And I think that about sums it up. I was looking at the question. So once again, I just want to thank Chuck for taking the time to be with us. Really a treat for me to have a conversation with you. I missed those when we were at the conferences. Chris, as always, I relish the time we have a chance to cover some of these issues. And thanks to all of you that joined us tonight and asked some fantastic questions to get us all thinking. Friday, we will come out with a follow-up for this webinar. It will have the link to the full recorded Q&A and everything. So look for that on Friday from us. And there'll be ways to get in touch with all of us, Chuck, Chris, and the folks here at Asset Strategies. And thank you. Happy Veterans Day to all, and have a great night.